For about 10 years, bonds were a punchline. Near zero interest rates made bond yields nearly meaningless. Why hold a 10-year treasury paying 0.5% when equities were returning 15% annually? Investors piled into stocks. Many under 40 never owned a bond in their life, and bonds got dismissed as what your grandparents held. Then 2022 happened. Equities fell 20%. Bonds also fell because rates were rising rapidly, which shocked people who expected bonds to be a cushion. Now, rates are normalized and bonds are relevant again. Let me explain what they actually do and what most people are still getting wrong. A bond is a loan you make to a borrower, typically a government or corporation, in exchange for regular interest payments and return of principal at a specified maturity date. The U.S. Treasury issues bonds to finance government spending. Apple issues corporate bonds to fund operations. Municipal governments issue muni bonds to fund infrastructure. The interest rate on a bond, called the coupon, is fixed at issuance. If you buy a $10,000 Treasury bond at 4.5%, you receive $450 per year in interest until maturity, then get your $10,000 back. That's the whole mechanism. The inverse relationship between bond prices and interest rates is the concept most people find confusing. When new bonds are issued at higher interest rates, existing bonds with lower rates become less valuable, because why would you pay full price for a bond paying 2% when new bonds pay 4.5%? The old bond's price drops until its effective yield matches current rates. This is why 2022 was catastrophic for bondholders. The Fed raised rates faster than at any point in 40 years, and existing bond values collapsed. Long-duration bonds, those with 20 or 30-year maturities, fell the most because their long timeline amplifies price sensitivity to rate changes. Duration is the key concept for managing bond risk. It measures a bond's price sensitivity to interest rate changes, specifically, how many years until you've received back half the bond's cash flows through coupon payments. A 2-year treasury has low duration, small price swings when rates move. A 30-year treasury has high duration, large price swings. In a rising rate environment like 2022, long-duration bond funds like TLT, iShares 20-plus year Treasury bond, ETF, fell over 30%. Short-duration bond funds fell 3 to 5%. Duration determines how much interest rate risk you're taking in your bond allocation. Why hold bonds at all for investors under 40? 3 reasons. First, diversification. Bonds and stocks don't always move together. In 2020's COVID crash, long Treasury bonds jumped as equities fell, cushioning portfolios. Second, volatility reduction. A portfolio with some bond allocation has smaller drawdowns than a pure equity portfolio, which matters psychologically and practically if you need to sell at a bad time. Third, yield income. At current rates, investment-grade bonds pay 4 to 5%, which is meaningful income with much lower volatility than equities. I-bonds, series, I-savings bonds, are one of the most underrated tools for individual investors. They're issued by the U.S. Treasury, backed by the full faith and credit of the U.S. government, and their interest rate adjusts every 6 months based on inflation. During the 2021 to 2022 inflation spike, I-bonds paid over 9% APY, risk-free. Current rates are lower but remain competitive. Limit $10,000 per person per year through treasurydirect.gov. 1-year lockup, small penalty for redeeming before 5 years. For your emergency fund or low-risk savings, I-bonds warrant serious attention. Common mistakes younger investors make with bonds. Mistake 1. Ignoring duration and buying long-duration bond funds when rates are uncertain. If rates rise further, long-duration funds fall. Stick to short or intermediate duration, BND, AGG, or VGSH, unless you have a specific thesis. Mistake 2. Putting bonds in taxable accounts. Bond interest is taxed as ordinary income, not at the lower capital gains rate. Hold bonds inside a traditional IRA or 401k, where the interest grows tax-deferred. Hold equities in taxable accounts where long-term gains are taxed at 15 to 20%. How much should someone under 40 hold in bonds? Traditional advice was 100 minus your age. Someone at 35 holds 65% stocks and 35% bonds. This is too conservative for most modern investors with longer lifespans and retirement horizons of 50 or more years. A more reasonable framework for a 35-year-old, 80 to 90% equities, 10 to 20% bonds or cash equivalents. The bonds serve as a rebalancing source. When equities fall, you sell bonds and buy equities at lower prices, improving your long-term returns without adding volatility-driven panic to the equation. The bond ladder strategy is used by retirees and near retirees to match income to expected expenses. You buy bonds maturing at different times, 1 year, 2 years, 3 years, and so on, so that each year a bond matures and provides cash without needing to sell in a bad market. A 5-year bond ladder for someone retiring soon creates predictable income, while the equity portion of the portfolio grows undisturbed. This strategy requires individual bonds rather than bond funds, which don't have defined maturity dates and can experience unrealized losses indefinitely. Bonds aren't your grandparents' boring, irrelevant asset class anymore. They're paying real yields again, and they play a specific, irreplaceable role in a balanced portfolio. The mistake isn't holding bonds. The mistake is ignoring duration, holding them in the wrong account, or expecting them to behave like a savings account. Get the allocation right for your age and timeline, hold short to intermediate duration, and keep them in tax-deferred accounts. And if you want to see how bonds fit into a full retirement portfolio strategy, my video on the 4% rule and FIRE math covers exactly how asset allocation affects long-term withdrawal sustainability.